Patrick, you, my friend, are back here in San Juan once again. We just got done with Bubble Trouble a couple of days ago. You having a good time down here?
Oh, heck of a Woody. Thanks for having me.
Yeah.
And the food is phenomenal. The scenery is phenomenal. People, except for one, are phenomenal.
And as a deacon, you never touch a drop of alcohol. And I've seen it. I've looked around. I haven't seen Patrick sneaking anything. So
you make sure that all the churchgoers and the pastor hear that.
We're going to pipe this right into your congregation.
Thank you.
So, what do we have on tap today? I know you've got a lot of questions from Bubble Trouble, and you've gotten a lot of questions in on the Buzz line. So, what are we looking at?
Yeah, I mean, Paul, it's easy to say that the number one thing that I hear most often, almost daily, is private equity. It's time I start learning something about it.
Yep.
We've had a couple Buzz episodes about private equity, but the questions aren't stopping anytime soon. It sounds sexy, a second bite of the apple, take some chips off the table. We've heard all the cliches.
All the buzzwords, yeah.
But I know no one has more experience with private equity and probably now taking more money from private equity than you.
No, as I mentioned on Bubble Trouble, I began my career on the buy side. So actually, I began my career on the sell side at Credit Suisse, and then I went to the buy side with American Capital, which at the time was the largest publicly traded private equity firm in the world. And we did a lot of roll-ups, just like what you see going on in pest control with Incentivise and Thompson Street Capital Partners, and there's a handful. And I think these are great questions because I think everyone out there gets, 5 emails a day from some sort of buyer, whether it's a strategic, whether it's a broker, a search fund, a pledge fund, a private equity firm. And you guys out there, you always get these emails. So first off, it's important to think about what sort of buyers you have in any process, right? You have the strategic acquirers, right? You've got Rollins, you have Workin, Terminex. Then you have the private equity backed ones, which I equate Anticimex not so much as a private equity play as much as I do as a publicly traded strategic like Rollins or Renikin. Okay,
cool.
And then from there, you have a variety of private capital providers. You have a mezzanine fund. And a mezzanine fund might buy some equity. If you think about the capital structure of a business, right? You have like senior debt at the top, then you have mezzanine debt, then you have preferred equity, and you have common equity. Now you, Patrick, were an owner of common equity, right?
Okay. I'm learning, you tell me.
And most pest control owners out there that own a pest, let's say you and I are a partner in a pest control. We'll call it Fat Pat's Pest Control, all right? So there's Fat Pat's Pest Control.
The pastor's still watching.
Fat Pat's, there's two of us, right? You own half, I own half. You and I both own 100% of the, or I'm sorry, together we own 100% of the equity, 50-50, all right? We each own 50% of the equity. Now, if we want to do a non-strategic deal, we have some options, right? We can do a 100% change of control transaction where we sell out all of our equity, right? And that's typically with a strategic. We can also bring in junior capital providers and say, you know what, Patrick, let's you and I pull out some cash from the business, but let's use debt capital instead of equity because it's cheaper. Okay? And what I mean by it's cheaper is whenever you think about an investment in a business, capital providers, whether they're debt capital providers or equity capital providers, are always targeting a return. And what a private equity firm does, or a mezz capital provider does, is they look at a business and they say, okay, I have a target return. I have an internal rate of return target over the next 5 years, for example. And depending upon where I am in the capital structure, I'm going to target a different return. So I might require 5% for senior. I might require a 15% return for mezzanine capital. I might require a 30% return for equity. So debt is always cheaper. It's cheaper for us to sell debt than it is for us to sell equity. Okay? You got that?
Still trying to
I get it. This gets a little bit complicated, but let's talk about that. What does this mean?
I really want to wrap my head around this.
That's why we're doing this.
Okay. And I've heard you say mezz debt before. Okay, so you've got preferred debt, lower return threshold.
Yes. Actually, you know what? While you're thinking about it, I'm going to give you a live example, an actual example in the pest control industry.
Like I'm not pretending to be dumb because I'm really getting more sophisticated on learning all this stuff.
I get it. So when you think about, let's go back to Jason Pananos and Jay Davis.
Okay.
Remember those guys? I don't remember what episode it was.
And I'm sorry, I don't have the number offhand.
So many of them now. It was easy when there was 25. Okay. So Jay and Jason started their career in financial services consulting. They went to business school. They got out of business school and they said, okay, we want to buy a company. We don't have any money. So what do? We got to raise money. So they became a search fund. A lot of the emails that come into pest control operators are from search funds. And the classic giveaway of a search fund is, we are trying to buy only one business and operate it. We love founder businesses. They use the words like partnering, so on and so forth. But the key word is one business. And they try to use that to differentiate themselves from a private equity firm that might be buying a bunch of businesses. Okay. So search fund guys neither have a lot of money, nor do they have the capacity to pay a lot for a business because they're going to ultimately grow it through acquisition. So if you want to make a lot of money when you sell your pest control business, you need to disregard all the search funders. And those guys are the most annoying. And they're great people, and I love them, and I love to sell their businesses once they grow them. But you don't want to be the guy that ultimately sells your business to a search fund guy, because the search fund wants to pay 5, 6, 7 times EBITDA, like literally half of what you would get at a prevailing rate in the market. Okay. So they go out and they buy VDCI, Vector Disease Control Incorporated. That's a vector disease mosquito company. So they buy that business when it was doing maybe $5.5 million in revenue. And they got a great deal on it. They borrowed some debt capital, and they raised some equity, and they bought this thing. So over the years, they grew it. And as the value of the business increased, they wanted to go out and make acquisitions. Now, they had an option. When they go out into the market, they could do a recapitalization of the business using equity, using debt, or a combination of the two. Okay. Now, if they were to use equity, they would have to give up a lot of ownership, right? So if you and I own Fat Pat's Pest, we each have 50%. Let's say that our business is worth $10 million, okay? Okay. And we want to take on a capital provider for growth. If we want to raise $2.5 million and we want that to be equity, now you and I are diluted out, right? Yeah. You and I effectively would own 3/4 of the business and we'd have a new 25% partner, right? Okay. So we're diluted. It's dilutive. It's expensive to us. We're giving up equity.
And we're talking enterprise value.
We're talking about enterprise value, okay, right? Okay. 10 million enterprise value. We raised 2.5 million at the money there. Okay. Now we own we own 3/4
between the two of us.
That's right.
Okay.
And now we've got a new partner, and it might be a small private equity firm. Well, Jay and Jason are sophisticated, and they went out and said, okay, we don't want to be diluted. We want to own as much of this business as we can, so we're going to use debt capital. Okay. So when they use debt capital, they go out to the bank, and the bank will give them senior secured lending. Now, we all know in this industry, we don't have a lot of assets, so we can't get a lot of senior debt. Okay. So we might be able to get senior debt in the amount of 1 times EBITDA, right? So in our business, let's say that our business is $1 million in EBITDA. Okay. We might be able to get $1 million in senior. Okay. We might be able to get some mezzanine debt or some subordinated debt up to, and I'm going to make this up because the market changes, but let's say we can do it up to 3 times EBITDA, right? Okay. So that means we can get $3 million in junior capital, okay, subordinated debt. Okay. Now, subordinated debt is subordinated to senior, and it's not tied to any assets, right? It's what we call an airball. It's relatively safe capital, safer than equity, but there's nothing that the lender can grab onto, no fixed assets if we default. So because the loan is more risky, there's a higher coupon, there's a higher rate of return. And so on a mezz debt, we might end up paying somewhere between 12 and 18% interest, okay, whereas we might only pay 5 or 6 on senior. Mm-hmm. And we might have to give up some warrants. And warrants are options to buy equity at a specific price. So now we've got debt at a higher coupon, and we now have maybe a little sliver of equity. So our capital structure looks like this. $1 million in senior, okay, $3 million in sub, okay, and then $6 million in equity. But the good news is you and I both own that equity still, 50-50. We haven't given up any equity. And on the sub debt, we might give up a sliver on a recap, but it's not massive. It might be 1 or 2% of the total equity. So now we've raised $4 million and we haven't given up any equity. Now, The smaller the business, the more difficult that is to do. When you start talking about $50 million in enterprise, $100 million in enterprise, it's easier. But what Jason and Jay did is they said, look, at every point in the we want to utilize the entire capital structure, and we want to bring on the least expensive capital. Yeah. So we want to be sophisticated about it. So how do we do that? How Jason and Jay did it, and how I've done it my entire life, is I never fall in love with any capital provider, whether it's a strategic acquirer like Rollins or Anticimex, whether it's a private equity firm, or it's a debt capital provider. So if you want to recap a business, you go out to a competitive process, and sometimes the processes we run might have capital providers at different segments of the capital structure. Meaning, say you got a $100 million business, okay, and we're trying to think about how to fine-tune the capital structure. And the principals say to me, look, Paul, we may want to have our cake and eat it too. We may want to sell some equity, get the proverbial second bite of the apple, but we're not sure exactly what we should do. One of the things that I say is, okay, let's put together the materials. Let's go out to a full process. We're going to get the strategics involved because they're going to set the investment value, right? They're going to push the high end, put the pedal to the metal. I'm really going to get some price discovery. I'm going to know what this whole thing is worth. Then I'm going to go out to some banks. I'm going to go out to some senior lenders. I'm going to say, senior lenders, I want you to give me the best deal on senior capital you possibly can. And now I've got senior lenders competing against themselves. Okay. Then I'm going to go out to junior capital providers, and I'm going to say, hey, I want a $20 million slug of mezzanine debt. What's the best you can do? And now I've got an auction process on debt capital going on. And I've got one provider comes in at 15, one comes in at 14%, one comes in at 12%, one wants warrants, one wants a piece of equity, one doesn't. And now I've got a competition amongst junior capital providers. Mm-hmm. And now I go out to a private equity firm, the guys that really want to own, they might want to own a majority of a pest control business. Now I'm running a process with actual private equity firms. And right now there's, 60 or 70 of them that are seriously looking at the pest control industry. I would say that there's probably 15 real opportunities out there as far as firms that want to invest in pest control businesses when the rubber meets the road, right? Yeah. There's a lot that are interested and they're still exploring it, but the ones that I know that are actually going to put their money where their mouth is, that number is relatively small. But when you're running these processes, one of the biggest mistakes I think most small businesses, and when I say small businesses, I'm talking about like 200 million in enterprise value or lower make, is they don't run competitive processes. Private equity firms, and I did this at American Capital. So when I was at American Capital, our goal was to go out, talk to companies. We weren't doing pest control back then. We were doing, we owned, Piper Aircraft and Case Logic and a variety of other like brewing companies and all sorts of stuff. But we were in a variety of, we were generalists. We were in a lot of industries. But the private equity firm comes in and basically says, hey, we're really interested in pest control. You could be a great platform. Fat Pat's Pest could be a great platform. You guys should deal with us. We're the best because we're patient capital. We're not under any compulsion to do a deal quickly. We bring in all these additional resources. And every one of their pitches sounds good. But really, at the end of the day, it is absolutely impossible. I know for an absolute fact that when you deal one-on-one with a private equity firm without running a process, inevitably you're leaving money on the table. I don't see many indications of that at all. Look, we had bubble trouble this week, and we were talking about some of the situations where, on some transactions that I saw last year, that the sellers either used inadequate advisors that have no experience in this, or no advisors at all. There was one case was $20 million and was left on the table, right? We talked about that this very morning. So there's a lot of...
I felt bad when you called me Fat Pat, but when you told me someone left 20 million, there's 20 million on the table that they missed out on this morning. Yeah, that was a punch in the gut.
Yeah, so look, if you're going to make the decision, and this isn't a sales pitch for Potomac. I think that we are the absolute best at this. I think we, got decades of a track record doing this, and in a lot of ways, I think the results speak for themselves. But whether somebody goes into this process and uses us or not, at the end of the day, you need to find a very sophisticated advisor that understands this and can run these processes. There's nothing wrong. A lot of guys will call me up and clients will call me up and say, hey, private equity firms contact us all the time. Is there any problem in sitting down and talking to these guys? And I say, no. Like you can actually learn by sitting down, listening to their pitch. But when you're ready to pull the trigger, you have to run a competitive process. I've been doing this for decades, and I myself have learned the hard way. When you try to do a one-off deal with an acquirer, you're always at a tremendous disadvantage if you don't run formal process with competition. Okay, we've kind of framed out the capital structure, right? So we understand we got senior, we got mezz, we've got equity. And equity is preferred, common. We're not going to get into that now. But when pest control operators are talking about private equity, usually what they're talking about is a firm coming in and buying somewhere between 60 and 90% of the equity of the business, right? So a big private equity firm would now own a portion of the business, a majority of the business, quite frankly, and the seller or sellers would continue to own a smaller portion. Now, the absolute best candidates for this sort of stuff are the businesses that say, hey, transaction multiples are extremely elevated and I want to take advantage of that. But I'm 45 years old and I don't want to be done with this. I love my team, I'm having fun, I could really grow this. What I could use is some additional capital. I could use some additional M&A expertise to really get an M&A engine going. I might need some capabilities. I want a professional board. I might want to partner with a private equity firm that has extensive experience in branding or building residential services businesses. If I can mix all these ingredients up into a stew, not only did I exit today for a huge chunk of money and my family for generations is taken care of, but now I have the ability with the money that I've rolled over into NewCo, into the new platform, I have the ability to make as much money 5, 6, 10 years down the line as I did today. So it's really a risk management maneuver. And you know, we had Jim on Bubble Trouble a few weeks ago.
I'm smiling. I'm thinking about Jim.
Yeah.
And I'm thinking about Jared. Two different exits, 2 different ages. Jared has a lot more kids, so I don't know if his money's going to go as far as Jim.
Yeah. So Jim. When, I worked with Jim since 2000 and, man, I don't even remember, the early 2000s.
It was before 2010 because
yes.
I know he's got me beat.
Yeah, so for a long, long time. And before we did the Anticimex deal, when we ran full process, Jim says, okay, transaction multiples will take care of us. I've got the family situation. We've got all these kids. I'm not going anywhere. I'm in my early 50s. I want to run this. My brothers want out. The absolute best thing we can do is run a formal process and bring in private equity. I'll own 1/3 of the business. My brothers will be bought out. A private equity firm will own 2/3, and then we'll blow this thing up. Okay, that's the theory we operated under. We went out to a very formal controlled auction type process. We brought in the strategic acquirers. We brought in some mezz capital providers just because I was curious. And we brought in private equity firms. There must have been 25 or 30 bidders in this process. At the beginning, we started broad, and then we narrowed it down. And at the very end, Anticimex's proposal was one that could not be beat. Now, it didn't start that way, and I remember there being at least a $30 million delta from where Anticimex began at the front end to where they were ultimately pushed to get that deal done. But that's how a competitive process works. You have multiple bidding rounds, right? And you're running it either, as we talked about, a controlled auction process. There might be a Dutch auction. I think was it Aftermath or on Hinge is when I actually went through the Dutch auction. I don't think we published the whole thing, but I went through the Dutch auction process. Yeah. I think in the Macau, I haven't used Dutch auctions often, but I think in Macau, we may have used a Dutch auction. Okay. I think we may have used a Dutch auction then. But either way, it got to the point where I think Jim even said on Bubble Trouble, Anticimex ended up being like $20 million north of where the private equity firms were. I don't remember the exact numbers. It was quite some time ago.
It's been a week. There was a lot of scotch.
A lot of scotch. But it was a significant delta. So the problem Jim had and his brothers had was that he's not going to sell to a private equity firm and leave $20 million on the table because his brothers need to get full value. Sure. So in 2018, 2019, when we ran Killingsworth, we did it with private equity. There were a lot of firms, like when we did VDA, private equity was in there. But private equity was not competitive with strategic acquirers back in 2017, 18, 19. But I have always kept them in process. I've been doing, just because not only do I have a bulge bracket investment banking background, but I'm a private equity guy. So I always keep them in process, even if I don't believe. I never make any assumptions as to who the buyer is going to be. You've talked to a lot of sellers, like they always say, well, who's the best buyer? Shouldn't we just deal with this company or that company? No.
It's like question number 2.
Do not realize that you have a lot of cognitive biases in your mind. You have absolutely no idea what you're doing. And you don't come with any preconceived notions. You let the market speak. You step aside, you let the process dictate what's going to happen, and you let the market speak. Nowadays, though, as I talked about on The Buzz a few weeks ago, the majority of the players in our processes now are PE firms. The private equity firms are clearly outbidding strategics, and they would not be outbidding strategic. Look, if private equity firms weren't outbidding strategics, you wouldn't have seen us do a Presto deal last year with private equity. You wouldn't have seen us do the Green deal or the Point deal or the other ones that are coming down the pike. Those would have never happened unless private equity can be competitive in process.
Well, we were in Atlanta a year ago.
That's right.
You were in the middle of, or the Mex at least was in the middle of doing due diligence. Pestban, Brian Alexson in town.
Yeah.
Jack and Kathy there out behind the scenes. And if I remember right, wasn't private equity serious about that deal too?
That's right. So the day we interviewed Brian Alexson in Atlanta, he was there doing due diligence on Pestban. And that was a company, as I talked about all last year about how competitive the process was, that was right during the supernova period, right? Or as David Billingsley referred to it as super bad, right? So we had done super bad for buyers. And it was in that period where we ran a very broad competitive controlled auction on Pestban. Tremendous amount of private equity involved in that business. One of the highest, I would argue that was the highest transaction multiple ever paid in the United States for pest control business. We went 25 deep on the front end of that process. It was a very interesting process. Private equity actually, on the margin, was, I think, more compelling as far as the financial proposition than some of the strategics. Pestban or Anti-Cmex just really made sense for the sellers, specifically because they were making that the Anti-Cmex platform for the Georgia area. So it just made a lot of sense for the sellers. They liked Brian Alexson. They liked Bill Talon, who's the new president of Anti-Cmex North America. They love Bill as well. So it just made sense for them. But you're right, that was private equity effectively drove up the transaction multiples. And that's what I've seen over the last 6 to 9 months, is that private equity and processes has driven up the valuations on strategics. They put a lot of pressure on strategics. And that's why, people always say, well, why do you need bidders in the process? Can't you just tell the acquirers that, hey, you got to pay X, otherwise we're not going to do the deal? It's really hard to do that. They're like, it's easy to be like an armchair economist when you're thinking about how do I sell my business and you're not in that very stressful situation of running through the process. But when you are actually in the thick of it and you've got $100 million or $150 million or $50 million or whatever the number is, but you've got $50 million on the line, right? And I'm trying to take the price from $50 million to $55 million. And you say, okay, that's a 10% delta. It's not huge, but it's an extra $5 million. And I would think for most people on the planet, $5 million, buy a lot with $5 million. It is really hard to give a strategic acquirer the finger if you do not have a plan B that's extremely credible, right?
Yeah.
So it's easy to fantasize that you can do that, but I dare you to have $50 million on the line with a gun to your head and tell somebody to piss off. So you've got to build that competitive process. And it's very nuanced, and you're always kind of walking a very, very fine line. And a lot of times, sellers themselves can't do it because they don't understand how to do it without blowing up their own deal, even if they've created a competitive process. So, I don't know, that's what I have to say on that.
I'll take that. The finger was not directly pointed at me. It was the strategic acquirer sitting between us. Thanks, Paul.
Yeah, let me think about who it was pointed at today. I don't know. It's pointed at somebody every day. I'm not sure.
But I know you're serious because I get a peek behind the curtain some at Potomac, and there's a recent deal that you said, like, if we can't get here, the deal's off, never happened. I mean, you're legit when you say it.
Yeah.
The conversation going all the way back to last night at dinner, sitting at Paulina's with the world's best bread pudding and ice cream, and I now know why you call me Fat Pat. It sounds like, I don't know how much you can dig into the details, but this Anti-Cmex and the way that they've encouraged and stimulated and developed their people and kept them around. There's a fund, or I know it's not publicly traded, but somewhere behind there is this equity or private equity that they can use to encourage, like, hey, we need to hit our SMART goals, we need to hit our numbers, and in a couple of years, this thing's going to be worth a lot.
Patrick, that might be one of the best questions you asked all week, actually. I'm not going to go into Anticimex' specifics, but we'll talk about this broadly with private equity. Okay. If, one of the things that I used to do is when we go out and buy a company, let's say we're going to buy a $50 million in enterprise business, right? You go out and you say, okay, we're doing a private equity deal. I'm the private equity firm. You're Fat Pat's Pest Control. And I said, Fat Pat, you're
getting too much enjoyment out of this.
You got a $50 million business, and you told me you're super stoked about growing it. You want to take some biscuits, butter them up, put them in your oven. So you want to take some chips off the table. And so I said, okay, Fat Pat, here's what we're going to do. I'm going to buy 80% of the business, all right? I'm going to write you a check for $40 million, and then we've got a $10 million roll, which is 20%, right? So you own 20%.
Okay.
You're at the helm, you're keeping your team around. But then I say, I'm not particularly thrilled by the fact that you own 100%, or you owned 100% of that business, and your team members, you pay them well. But I really want these guys to cook with some gas, because I want to take this $50 million business, I want to turn it into a $500 million business, I want to sell it 5 years from now.
Okay.
So I might take 10%, maybe 5%, but 10% of the total enterprise value of the firm. So if I take 10%, I might take $5 million in equity, right, at the entry price. And I might make a stock option pool. I might do equity grants, or I might do stock options, but you're going to help me identify the key players in that business.
Okay.
And I think for maybe the top 2 or 3 people, I might grant them some equity. So now they're partners. Hey, you've been around 10 years, done a great job. You're extremely helpful in building the business. Okay. I'm going to give you a little equity.
Just to make sure I'm really following the math here. $50 million business. I got $40 million to walk, and I gave up 80% equity.
Correct.
Okay. Now you're Paul's private equity. I'm Fat Pat's Pest, and you're going to give up in that $40 million, right? In that,
you know what? We should have used $100 million, so let's use $100 million because it's easy from a percentage perspective.
Okay.
So I gave you an $80 million check. You got 20.
Okay.
20% of the equity was rolled. We've got a $100 million enterprise business. I own 80 million. You own 20 million. We've loaded a lot of debt on it too, right? So, but the enterprise value is 100 million.
Okay. So now you want to incentivize some key people.
That's right.
Okay. So out of the 80%, you're going to give up some of the 80%? Is that where this equity's coming from?
You and I are collectively going to give up a portion of that new co. So you've already got your $80 million in cash. That can't be touched. Okay. Now, 20% is owned by you, 80% is owned by me. Collectively, you and I are gonna, so you own a fifth, I own 4/5. Every time I take a stock option, you're paying for 1/5 of it, and I'm paying for 4/5 of it.
Okay.
So we're gonna be diluted. You and I are gonna dilute ourselves down, but we're gonna share the love.
Okay.
And we're gonna give some equity, and we're going to set up a stock option pool, and it might be incentives based where, hey, if we increase the value of the business by X amount, and when I was at American Capital, we'd market to market and value. We had a valuation team that would value each portfolio company on a quarter by quarter basis because we were publicly traded and we had a market to market. Okay. A lot of private equity firms that aren't publicly traded still do that. That way we know, sometimes they do it annually, sometimes they do it only when there's some sort of a liquidity event or a recapitalization or large acquisition, for example. But for the most part, we're going to keep track of the value of that equity over time. And we might say to the management team, these options that I'm giving you today are worth nothing at 100 million, right? They're worth nothing. But now, if you have 1 million options, let's say Jim, we give Jim 1 million options. So at 0, at 100 million enterprise value, they're not worth anything. But if we increase the value of the business by 100 million, his $1 million, his million options, depending on where they're struck, he might end up with $500,000 in value or $200,000 in value. And the more the enterprise value grows, the more he gets from his option value, the more he gets from his equity interests. So you'll find situations where, sometimes, in a private equity deal where somebody buys a $50 million enterprise business and turns it to a $500 million business, you might have certain situations where certain managers walk away with $5 or $10 million just because they've really gotten a lot of incentives.
So while I was hearing this like 80-20, 60-40 preferred, what does all that mean?
So let's talk about our deal. So we did our deal. It was $100 million. You're rolling $20 million in equity. So I was supposed to write you a check for $100 million, but I wrote you a check for 80. Mm-hmm. You're taking $20 million and you're putting it into Newco. So that's Patrick's money, $20 million. Now I got to come up with some cash as the buyer, the private equity firm, and I want to juice my returns. And of course, equity is the most expensive, so I want to use debt capital. So while I'm trying to buy, before we close your deal, I take Potomac Sim. I'm the buyer. I take Potomac Sim and I convert it into a bank book, and now I go out and I auction the debt. I go to all these capital providers and I say, hey, I've got this $100 million business. Here's the fundamentals. How much debt will you give me and at what price? All the different banks, there might be 50 of them, come in and say, I'll give you X amount in mezzanine debt, X amount in senior lending. I might want some warrants. And they have a bunch of different proposals. We figure out which works the best from us. Mm-hmm. And I might put, in 2021, you could put, somewhere around 7 times leverage, 7 times EBITDA and debt on these businesses. Now that's changing when you look at the high yield markets. Credit markets are starting to turn over, and I think they're going to turn over badly, which is ultimately what I think is going to impact private equity's ability to compete with strategics. Right now, we're in this perfect storm where credit markets haven't turned over yet. Private equity has been resilient. Okay. There's a lot of people that say, when you hear about, Tim Maroney talked about it when we had him on the Terminex Run a Kill edition. He said, well, private equity will step in. The private equity firms are saying, we'll step in. The problem is, I've lived through the dot-com bust. I've lived through the financial crisis. When credit markets, when credit spreads blow out, meaning when yields spike on things like treasuries, credit markets, fundamentals change, we get into a quasi-recessionary environment, banks are not willing to take as much risk as they are today. And I think we are seeing that as a process unfold in real time. We've seen spreads widen this very week. The Fed announced literally live on Wednesday when we were doing bubble trouble. They announced a 50 basis point hike. There was a relief rally. Everyone's like, oh, this is great. They're not going to do 75 basis points. As you'll recall, the market shot up and I sold it short at the end of the day. I shorted everything. And that over the night, it rolled over and we lost. I think the next day, the Dow was down, 1,100 points. So that was the fading the Fed relief rally because credit conditions will continue to deteriorate all throughout this entire summer. So again, there's lags to monetary and fiscal policy, but I think at the end of the day, we are in a position right now where the credit market is healthy enough for financial sponsors to lever, and it's going to change. In 12 months from now, it'll be a very different market environment, and private equity firms will be able to not pay as much on the front end. But then valuations will go down, so it won't matter as much because it's a system, right? Yin and yang.
So where's the 80, 20, 60, 40? Where's all that? How's that work?
Well, so what do you mean the
returns?
80? Yeah, so I don't want to get too complicated, but when I'm a private equity firm, so I bought Pestban Pest, and I went out and I got bank lending. So I went out and I got, let's think about some numbers here. I'm going to use very basic numbers. This is not representative of a real deal from a multiple perspective, but from a capital structure perspective, it is. Let's say Fat Pat has 10 million in EBITDA. And let's say I was able to borrow conservatively $50 million, right? Okay. So let's say that our capital structure post-close looks like this. $100 million equity value, or $100 million enterprise value. Okay. 50 million of that is debt, $50 million of that is equity. Now, if you think about a home, right? You walk into a neighborhood and you look at a house and it's got a $500,000 price tag on it, right? That's the equivalent of the enterprise value of the home. Now, if you've got a $250,000 loan on that home, you've got $250,000 in debt, $250,000 is your equity value in the home, right? But still, you've got a $500,000 enterprise value. Same thing. So, our capital structure is 50% debt, 50% equity. It could be 60-40, it could be 80-20. There's a variety of different things. But let's say in this example, it happens to be 50-50. In the capital structure, you've got equity on the bottom, and then you've got debt. Now, we might have preferred equity, but let's not overcomplicate it because I don't think it's really relevant for this discussion. Okay. 50% equity. On the debt side, we might have $10 million in senior secured, which is the lowest coupon. It's the lowest interest rate, but it's tied to some collateral. Meaning, if we go bust, the bank can come in, take our trucks, take our buildings, take all sorts of stuff. So they're covered, okay, right? Lowest interest. Then below that, we might have subordinated debt. We have senior subordinated, junior subordinated. Now, the lower in the capital structure, the return requirements are higher. So senior might be 5% or 7%. Mezzanine might be 10, 11, 12, 15, 18, 19. Junior mezzanine might be 21% required rate of return. And equity, of course, is 20, 30, 35%. And that just shows that it gets more expensive the lower you get in the capital structure because it's more risky, right? Sure. Junior sub, senior sub, when I talk about mezzanine debt, that's usually a 10 to 15% coupon. And that could either be paid, there's a million different ways to skin the cat on debt. So you could go out, we've done deals where we borrowed $10 million in mezzanine debt, all right? 10 million bucks, it's debt, it's not equity. And we have PIK interest, meaning that we're paying interest payment in kind. It's a 10-year term. So I want you to think about this. I borrowed 10 million bucks, right? And I've got to pay principal and interest. Okay. But what happens if I say, well, I want to use this money for acquisitions and I'm going to be tight on cash flow. I can pay the interest. You want a 10% interest rate or a 15% interest rate? I'll be able to pay that. I just can't pay that for a few years. Okay. So the capital provider says, okay, I'm going to charge you a 15% interest, but it's going to PIK, P-I-K, payment in kind, which means I'm not actually writing a check every year for that interest. Mm-hmm. That interest is being tacked onto the principal. Okay. Right? Okay. So if it's 10 million bucks and it's 15% interest, how much interest am I paying?
1.5.
There you go. So instead of writing a check on a quarterly or monthly basis for 1.5 million in aggregate, okay, I'm adding at the end of the first year, my balance now is not 10 million, 1.15. It's 11.5. Yeah. And then the next year, and so it picks. And that allows, the negative of that is interest upon accrued interest. Yeah. But the benefit of that is now I've created 1.5 million in cash flow. I've got extra money now that I could use. And if the cost of that debt capital is lower than the hurdle rate on the projects that let's say I'm paying the provider 15%, right? I got to pay the capital provider 15% on that sub debt. Yeah. But if I'm looking at it and I say, look, I got this project where I know I'm going to get a 25% internal rate of return, yeah, I'm making the spread. Right. So I'd rather push off that interest payment and make that 10% spread. I'm printing money there. So that's how we try to get sophisticated about capital structures. Okay.
This is really helpful, and thank you for dumbing it down for me. Questions, I'm just rolling in my brain here. Who is private equity for, not for? And I'm thinking two different ways. Yep. Size of the business or EBITDA, right? Hey, we're a private equity company and we're looking for businesses that are this much in EBITDA or bigger. That's one. And the other is the retirement age component. Yeah. Hey, if I'm 70 or 80 and not really planning on working much longer, is private equity an option?
Great question. Private equity firms are they're levered equity bets. Right? So they're levered equity, meaning you're taking equity and you're levering it up with debt. Now, I know that some private equity firms that are listening to this right now say, well, Paul, I disagree with that because we don't use a lot of debt. We're very equity heavy, so you shouldn't look at it as a levered equity play. And so I'm making a broad-based assumption. But anyway, private equity firms typically will need to lever free cash flow. So we talked about the fact that it's hard to get senior secured debt for a pest control company because it's very capital light, right? There's no fixed assets for banks to grab a hold of. So we're often levering that free cash flow stream. And that's what a sub-debt lender, and there are all sorts of lenders that will do this, but We're levering an airball. We're levering just cash flow, okay? And to a certain degree, the pest control contracts are collateral because they're very fungible. They can be sold to big acquirers very quickly. And I field calls like this every day where lenders are looking at this saying, Paul, if we loan 20 million bucks and we have to get out quickly, what does it look? How do we exit? So on and so forth. Okay. So, number one, private equity firms are looking at the cash flow stream above all else, right? They're looking at cash flow. And cash flow is really just a result of high pricing, heavily dense routes, so you have high gross margin. It's in very basic terms, it's quality businesses, right? They're looking at levering cash flow. Yeah. From a size perspective, you've got, most of the private equity firms that are in the space right now would prefer to do deals in the 50 million enterprise value or above. So we are talking about minimum 10 million in revenue, pest control company, give or take. Okay. It gets very difficult now, I'm not saying, again, I always say don't make assumptions, explore the market. And so when we explore the market, Thompson Street Capital, their entry acquisition was Ken's business. Presto was maybe doing 6 million in revenue at the time it was acquired. Now, had I made the assumption, you're too small for private equity, then I would have never taken it out to process and we'd never be here where we are. Ken was at retirement age. Okay. That was a deal. Their entry acquisition, they were willing, they loved Ken, they loved the business, they provided incentives for the management team. It was a great entry acquisition. They allowed Ken to do 100% change of control. Okay. So Ken's out. Okay. He's retired. He's super happy. He's working on his skin cancer by the beach. And so I only know things if I go out into the market because what happened last month will not happen again next month. I always say, and I've said this since the beginning of the Boardroom Buzz and back when I was writing a lot of commentaries, the market is dynamic. For the love of God, pest control operators realize this. It's not the same 1 week. You can't make assumptions. So I, for once, took my own advice and said, I'm not going to make an assumption. I'm running process. And it was a spectacular outcome for all involved. Great for Thompson Street and Pesco, great for Presto and Ken Fox. But I would say, on the whole, you want a business that is cash flowing. Ken's business was cash flowing. Mm. There are certain door-to-door businesses out there that have very, very narrow margins. They're not prime private equity plays as much as they might be potentially some sub-debt plays. But I think it gets very difficult when you have a business that's not cash flowing because it's hard to lever that. And the less leverage a private equity firm can use, the lower their returns will be. It's like anything, right? It's like if you go out and buy a piece of commercial real estate, let's say you're gonna buy an office building, right? And using round numbers, let's say it's $100,000 purchase price and your rents, you're netting $10,000 a year. What's your return?
10%.
10%, right?
Thank you for easy numbers.
Now, it's 10% on equity if it's all equity. Okay. Now, what would my return be if I use 50% debt and 50% equity?
5%?
20%. Doubles, right? So I'm using 50% debt, 50% equity, and now my return is 20%. Okay. So the more leverage you can use will magnify your returns. It also makes the enterprise more risky because you've got debt service. Okay. So there's always a balance between how much debt and equity you should use. And when you think about corporate finance theory, there's a lot of research. Every college finance book talks about optimal capital structure, right? Using the tax shield of interest. And we're not going to get into that today, but that's how you think about returns. So private equity firms want to use as much debt as possible, but not as much debt that will get them into a dangerous territory of any sort of default or not being able to weather a downturn.
Mm-hmm. Paul, I know it's taken me years to figure out you're really sell-side advisor and that's your specialty, but I know you have tons of experience and years also on some on the buy side, yep. Private equity. So I just want to know, do you field these questions where hey, Paul, we're looking to buy or we're looking to get in pest control. How should we structure debt? Where do we need to raise our debt? I want you to run a competitive process so we can have good debt.
For the larger companies, yes, we'll actually run the competitive processes for debt capital. So yes, 100%. The majority of, I think that's starting to change now where it was very rare before. And I think as pest control operators are going to become more sophisticated as to their options, we've been done more and more of that. And I've really tried hard to educate our clients. So most guys out there don't understand that you could go out to the market and you could find a mezz fund or an SBIC that will give you debt capital with a sliver of equity that's not a private equity firm per se. They might call themselves XYZ Capital and they look like a private equity firm, but they're not investing in equity. They're investing in debt with warrants, for example. And so what I often do is after we do a preliminary evaluation, I look at the capital structure of the business and I say, okay, you're 100% equity. And if you're fine with that, you're fine with that. But we could pull out 10 or 15 million and you could literally use that money to buy a $10 million house in Southern California, or you could use that money to grow. Do you want to pull equity out? Do you want to be all at 100% equity? Do you want to be 80%, 20%? How do you want to do it? So I spent a lot of time thinking about the capital structure. Okay. Because I'm not an accountant, I'm a finance guy, and core to finance is thinking about capital structures and returns on those different slivers of the capital structure. And I think small businesses are really focused on growing their business, incentivizing their people, all those sorts of things. You're not thinking about a capital structure at $1, $5, $10 million. You start to become a $20 million firm, a $50 million firm, $100 million in enterprise value firm. Now you have the luxury to think about an optimal capital structure. Do I want to pull some equity out and replace it with debt? And how do I do that? So yes, I love those conversations. In fact, I used to have those conversations with Orkin or with Rollins. I used to look at their P&L. I remember 10 years ago, I was down with Gene Iarocci, who was a former president of Orkin. I remember sitting there at lunch in Atlanta with him. CFO was there, and I said, why on earth do you have such an unlevered capital structure? Orkin and Rollins used to always boast, we have no debt, we have no leverage. Now, that feels great when you pay off your house, but when you're a multi-billion-dollar publicly traded company, that is a very poor use of capital because debt capital is less expensive than equity capital. So provide your shareholders with a higher dividend and a higher return by pulling out some of that equity and replacing it with debt. And that's exactly what they've been doing. And actually, Matt Whiting, I think, has been instrumental since he came on in 2014 in having these. I mean, Matt gets it. He and I have talked about this. So I think he's done a lot to actually help change and augment Rollins' capital structure.
Oh, that's fascinating. Didn't know that.
Yep.
I know I'm not allowed to pick your brain. We learned that a long time ago.
No brain picking, yep.
But as learning the whole investment side of things and figuring out the 60-40 and running through numbers today, I really appreciate it. It gave me a glimpse of what's going on with private equity right now.
Yeah, and I would encourage all of our friends out there in the industry, if you want to explore private equity, it is a far more complicated process than just dealing with a strategic acquirer like an Orkin or Rentokil. So give us a call. I'm happy to chat with anyone and kind of run through various different options. A lot of you, unfortunately, it won't make sense for a private equity firm to invest or for you to partner with a private equity firm. But I think there is a subsection in the industry where it really does make sense. And I think you can't have your cake and eat it too. You can get a very high multiple, equivalent to what you would get and sometimes beat a strategic, take out some equity. It's exactly what Jared did. Jared ran a very formal process. Jared and Kyle are textbook examples of doing a proper levered recap of a business, having their cake, risk managing their future. They're not as worried about as the markets roll over this year, as things take a deep dive. They've taken their chips off the table and they're gonna have a lot of opportunity to reinvest that at lower valuations going forward. And still, they get that upside. Jared might be in this 5 or 10 years and he's gonna reap the rewards. So track us down, happy to chat with you about it.
All right, well, thanks for having me again. This is awesome, it's been beautiful, great week. Great job with Bubble Trouble.
Thanks, Patrick. You too. Until next week, guys, thank you for joining us.